As stock prices head higher, Apple and Amazon are warning investors that the economy is slowing. Small businesses may be in jeopardy of failing over the holiday season. And who's buying bonds? That's right, the banks are buying bonds. All that and more on today's show. I'm your host, Steven Van Metre, and thanks for joining me today, because the story that we're leading with is how Apple and Amazon are letting you know as an investor that the economy is slowing. Now, we look at data on the show all the time, and what do we see? We see the growth rate slowing. We know that means that inflation is going to cool off and start to become disinflationary. And for those of you who watched the Dr. Lacey Hunt interview on Tuesday, well, you know that the probabilities of disinflation are really high, and we're starting to see it in some of these big company earnings reports. And you should be paying attention, because what the big companies do, well, guess what's going to happen to the mid and small companies? It's going to be worse. Let's kick off with this headline. The U.S. economy slowed in the third quarter on Delta surge supply crunch. Factors that fueled spending faded, including an infusion of government stimulus, business reopenings, and rising vaccination rates. Now, as we get deeper here, check this out. The U.S. economy grew at the slowest pace of the recovery in the third quarter, but, and here's the but, economists expected strong consumer demand and an easing pandemic to boost economic growth in the coming months, despite lingering supply constraints. I want to challenge that statement of strong consumer demand that they think is coming, and I want you to challenge it as we go through the data today, because I don't think it's going to be there. We're going to find out. Let's continue on, because what happened with the GDP report, we saw Q on Q, quarter on quarter drop from 6.7 down to 2, missing expectations of a 2.7% print. Remember, on Wednesday, we looked at the Atlanta Fed GDP growth estimator, and it had a 0.2. So was the Atlanta Fed too far off? Well, not really. But let's take a look at what the gross domestic product is so you understand it, and how we did and how we are able to predict the economy is going to slow even further. Gross domestic product is the total monetary or market value of all finished goods and services produced, here you go, within a country's borders in a specific time period. As a broad measure of overall domestic production, it functions as a comprehensive scorecard of a given country's economic health. So I want you to be thinking now, as we go to the next slide, is it has to be stuff produced inside the borders. So when you think about what's sitting off the port of, say, Los Angeles and Long Beach right now, is that GDP plus or GDP minus? Well, let's take a look, because here you see the trade balance, goods and services balance of payments in blue on the left, GDP year over year. So this isn't showing the Q on Q, because we can't get that through the FRED database. And so what can we predict for the gross domestic product of this country? Well, it's going to head lower on a year over year basis. So we know that the next quarter on quarter is likely to be below 2% or perhaps even negative coming up. Now, so that would be the fourth quarter prediction based on what we see right now. And now let's talk about what's going on with Apple and Amazon, because Apple warns of supply chain woes, while Amazon faces increased labor costs. Investors remain watchful of how pandemic-era leaders, again, these are important because these are the big companies. If you're a mid-size or small company, well, if the big companies are having problems, well, then you're having problems too. How they manage disruptions as the effects go on. Apple, which has recorded a 12-month profit nearing $100 billion, warned that supply chain disruptions are hindering iPhone and other product manufacturing and would bring increased challenges during the important holiday shopping quarter. And I think that's kind of the real story here, is the coming holiday quarter. If Apple cannot get iPhones and other devices to sell, how can you buy them? And so the idea, at least the belief right now, is that consumers have a ton of money, which we're going to challenge that view in a moment, and they can't wait to go spend it. But what if they can't spend it because the product they want isn't there? Well, that would lead to further inflation, because manufacturers and wholesalers and retailers could drive prices up for those who can't afford them. But what about businesses that can't get enough inventory? Apple doesn't have a money problem, but a lot of other businesses do. And that's what I want you to keep in mind as we go through some of these slides. Now, Amazon posted lower than expected third quarter sales as labor and supply chain challenges pushed costs up to $2 billion and made it harder to meet demand. The company has had to reroute products and seen inconsistent staffing in some areas. According to executives, sales of $110.8 billion fell below expectations as profit of $3.2 billion fell about 50% from the same period. So what you're going to see, as we've seen in the data, is these costs for supply chain issues are going to be absorbed by some companies. They can't pass those entire costs on to consumers. They're going to try to, but we're going to see that that's likely to be rejected. Let's continue on. That merchants are suffering, according to Shopify CEO, who warns about deteriorating macro backdrop. So what has he got going on here? The founder and CEO, co-founder and CEO offered a grave warning about online merchants. Now, this is great because this is a company that deals with a lot of merchants on its e-commerce platform. He said that the current macro backdrop of supply chain chaos and inflation is producing hardships for its merchants. Again, if they are struggling, what is that going to mean to their financial health? The challenges are, of course, real. He says there are pressures in the supply chain that are increasing logistics costs and things like this. And he goes on to say, quote, inflation is harder for us to judge. There are probably some inflationary things going on. There probably are. That's good. We have no idea if they're shorter or longer term. Well, we have an idea already that they are in the shorter term nature. And how do we know that? Because one of the ways we can look is at South Korea, a major exporting nation. Industrial production month over month dropped 0.8% in September. Look at the year over year, minus 1.8%. So it tells you that their industrial production is contracting from a monster 9.7 print in October. So let's continue with that story. How about from the U.S. perspective? So what are we seeing? And now we're starting to see exporters having trouble. But what about domestically? Where are U.S. consumers? Where is their financial health? Because as you may remember from the Lacey Hunt interview, we discussed how we didn't think that consumers had the money to support these higher prices. Well, do they? Let's take a look at this. Personal incomes month over month in September fell minus 1%. And that's big drop. And we can probably bet that number is going to continue to drop as more and more people fade off of the fiscal stimulus support from the pandemic. How about personal spending was up 0.6? So what does that mean when you look at the two of these, that Americans spent more than they made? So they spent more than they made, adjusted for inflation. Wherever you see reals, swap that out and put inflation adjusted. Personal consumption was up 0.3%. So just keep in mind, Americans are spending more than they're making, but can they do that for long? Well, not really. The personal savings rate is now back to where it was before the pandemic as a percentage. So it's around 7% of savings rate. But how about in total terms, in dollar amount, personal savings, you can see was typically around a little round or above $1,000. So that's how much people had and for emergencies. And now we're getting back down to that level. We're just above where that was before the pandemic. So if you think about savings as future consumption, right? If you're struggling with that notion, think about this. You want to go on a vacation, but you can't afford it right now. So you start saving some money every month, and at some point down in the future, you have enough money to go on vacation. So savings become future consumption. Well, what are we seeing with savings is they're going away, and that means Americans will not be able to afford all the things that they were affording, spending money on during the pandemic because they had all of that excess savings. And that is going to be a problem for a lot of businesses, as we're about to see, because the global chip shortage is far from over as wait times get longer. Now, nearly a year in the crisis, some customers are finding it's taking months more than expected to get what they need. And that is a challenge because check this out. Manuel Schofeld placed an order in May for transmission chips for the utility monitoring devices made by his New York-based company, PowerX. It's told chips would arrive by summer, then fall, then winter, and now doesn't expect to get them until May of 2022. Now, so this is the issue that I see facing small businesses is what if that is your business model where you're buying components and assembling them into your product and selling it? What if you can't get things? How long? How much money do you have to survive until you get the parts you need to get them to market and sell? And I think that is a challenge, as one of the challenges as we go into the holiday season, is just that, is the supply chain disruption is going to lead to business failures, not because of intention, because they can't get the parts they need and they don't have the savings, as you just saw, to get through an extended period where they don't have enough stuff to sell. So they keep that in mind. Now, what's left is widespread confusion for manufacturers and buyers alike. Some buyers are trying to place new orders or getting delivery dates in 2024. Said Ian Walker, Operations Director at Electronics Component Distributor, which helps companies find chips. So, hey, you can't find chips. You call this guy, and he's telling you got to wait maybe 3 years. Can your business survive 3 years without getting the parts it needs? And then meanwhile, you go to the Port of Long Beach, the chief there says, hey, shop early. It snarls to last all year. And here's another story that I think is we're going to see is you look at the holiday season. It's very critical for a lot of businesses. There's businesses that are real key to around the summer months, and then there's key businesses that are key to around the holiday months. As we know, with Black Friday coming in November, that's a date where a lot of businesses go from the red into the black because they have enough sales. But imagine this. Imagine that you have a bunch of holiday orders, fall orders, winter orders. Maybe it's winter coats. Maybe that's your business. You sell coats. You've got a bunch on order, and they're parked off of on a ship somewhere on the coast of Los Angeles. And due to the backlog, you don't get them in time. In fact, maybe spring starts to show up before your coats show up. How do you sell all these winter goods? How do you sell these holiday goods if the holidays are already passed, if the winter months are already passed? Do you see the challenge here? Because then you're going to have retailers who aren't going to want this inventory that they've already ordered. And the wholesalers aren't going to want it because they've got nowhere to put it. And the manufacturers they certainly don't want it shipped back to them. And so now you've got a problem where there could be inventory building up on shelves that just isn't at the right time of the year to sell, and nobody wants it, and that means it gets discounted. And again, you start to get to this, what I think is likely to happen is an inventory buildup of stuff that people just don't want right now. And that would be the challenge for a lot of retailers, and that would certainly lead to a lot of deflation in prices. Let's continue on, because are the consumers, that is the story, are the consumers going to spend? Now, we looked and seen that they don't really have any savings. And what about how they view the economy? Well, we got the latest University of Michigan consumer sentiment in blue, sitting right at the same level it was at the bottom of the pandemic when consumers were not confident about the economy at all. And then you look at the current conditions, how they feel today, right near the pandemic lows. And how about expectations for the future? Well, they're at the same point at the pandemic lows. So consumers are not confident at all. And it makes sense because they've got higher prices to deal with. They've got higher energy costs, higher food prices. We're going to look at higher rents are coming. And what do they have? They have not much of fiscal stimulus. And a lot of them right now still aren't back to work. And so that is a recipe for not a booming holiday, but quite the opposite. Let's continue to look at this. University of Michigan buying conditions for houses in blue perked up a little bit, but still remain in multi-decade worst conditions. How about vehicles in red? Continues to head lower, multi-decade lows. In large household durables, well, they are back at their lows last seen at the great financial crisis and during the pandemic. So consumers aren't looking to spend because they still see that at least inflation in the near term is going up, but long term they see inflation not really going as high. And so what does that mean? That means consumers think inflation is transitory. If you think inflation is transitory and you're going to buy something, guess what you do? You don't buy now. You stack up your cash and you wait because you're going to wait and buy it when the prices are lower. This is what the University of Michigan data is telling us is going on. How about this? Invitation homes boost their rents by 11% as housing crunch persists. Hey, welcome. Nothing says welcome home, right? Like higher rents. The largest owner of U.S. rental houses isn't seeing any let up in demand or its ability to increase rents. They own more than 80,000 single-family rentals, raised prices by nearly, imagine that, 11% in the third quarter. The company boosted rents by 8% on renewals and 18% when leasing to new tenants. So rates are rising fastest in the Southwest, where rents increased 30% on new leases in Las Vegas and 29% in Phoenix. Wow. So that's going to take away, again, I want you to think of this from a consumption standpoint. These people that are taking on higher and higher rent costs, what does that mean to their discretionary spending? it tends to go down. You got rent, food, and energy that you got to pay for, and the rest of the stuff, well, you can think about. All right, let's continue on because there's some good news. In U.S. jobless claims fall to new pandemic lows as employers are holding on to their workers while struggling to hire more. The initial claims for unemployment decreased to 280,000 last week, which was good news. You're seeing continued progress back toward the average before the pandemic. An economist at the human resources software firm ADP said before Thursday's data, hiring demand both remains strong, making companies eager to hold on workers while they have been trying to hire others, even though the initial claims for unemployment remain about 40% above normal. It has been a challenge for employers, especially in low-paid service jobs, to keep workers on staff. Well, if the savings rate's an indicator, that may not last too long. Layoffs are decreasing at the same time. A record number of workers are quitting their jobs, showing worker confidence in the labor market. And what they're trying to suggest is people are quitting their job to take on a higher paying job. And there is evidence to support that. Around 4.3 million workers left their jobs in August, the highest recorded monthly figure since 2000. Workers who leave their jobs voluntarily don't qualify for unemployment and therefore don't show up in the claims figures. So we aren't seeing that wave of job seekers coming back, and that's because first and foremost, we're still in a pandemic, and we see employers are trying to figure out, how do I get the workers I need? And using different tools to do that, like offering starting bonuses, hiring pay, and more benefits. Of course, one of the biggest risks that workers are going to find is that employers are going to automate more and more, and that will in the end lead to fewer jobs. So there's a challenge here, as workers don't really want to go back to some of those jobs, but with their savings dwindling, they may be forced back. All right, let's continue on because we've got the H.8 report that I forgot to go over. I think it was last week. And some of you said, hey, we missed that. But what do we see here? Bank credit is rising. Securities in bank credit are up. But check this out. Mortgage-backed securities up $6 billion. How about treasuries that nobody wants to buy? Well, the banks bought 31 billion of them. And now you might want to wonder what the banks are up to. Why would the banks be buying treasuries? Well, we know the Fed has enabled banks to now join the standing repo facility, which is good news. That creates demand for treasuries. But look, if the Fed isn't going to drive rates lower, then the banks will. Now, if you think the banks want higher rates, they not necessarily. Now, I know the simple math is, well, if the rates go up, they make more interest on the spread of the loan. That is true. But do banks make most of their money on the interest and loans these days, or do they make them on all the fees that they charge to do a loan? And if you believe that they're making their money on all the fees, well, then they don't care if the rates are higher or lower, because if you want to do more transactions, you do them at lower rates, not higher rates. And that's why the banks are stepping in and buying treasuries to push rates lower to spur lending growth, because it's anemic right now. We're seeing most of the bank's balance sheets that we're seeing growth is in their purchase of mortgage-backed and treasury securities. Loans and leases, commercial banks up about 14 billion, commercial real estate up a couple billion, real estate loans up a couple billion, commercial real estate loans down a little bit, consumer loans. So consumers are still driving the bus, up a few billion. The key, though, is cash assets at banks are starting to slow down, perhaps as an indicator now with the fiscal stimulus gone, that consumers are perhaps in big trouble, and that could spell bad news with the holiday season coming. And you now know that Amazon and Apple, well, they already told you what their situation is, and what that means is there are more bad things to come as we approach this critical holiday season, when we already know for a fact the U.S. economy is slowing. It could be in a contraction by the end of the fourth quarter. I'm Steve Van Metre. Thanks for watching. As always, appreciate you being fans. I will see you, for those who watch the Sunday chart show, I'll see you then. And if not, we'll be back on Monday to see what the news brings us. I hope you have a great weekend. Bye now. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This shows not to be construed as recognition or solicitation by or selling security, financial instrument, or participate in any particular trading strategies. Video was prepared by Steve Van Metre on personal capacity. Opinions expressed this via that do not reflect the view of Alice Financial Advice Inc. or Steven Van Metre Financial.